How would you characterise MOL Group's 2014 performance?
I think we had a strong performance with $2.2 billion clean CCS EBITDA in an environment which, especially during the end of the year, was testing and challenging. However, in this environment, I think we could show that we have the fundamentals for the good performance, which is we have an integrated upstream downstream business model, we have a strong balance sheet, and actually we have a strong team in place to face the challenges.
And can you elaborate a little bit more about the performance of the business segments across the year?
If you're looking at the two major segments, in downstream, the clean CCS EBITDA result was actually the best fourth-quarter result what we had in the last 10 years. And actually, in the fourth quarter, downstream contributed 50% of our clean CCS EBITDA, which again, clear proof of the strengths of our integrated business model. Ferenc will tell you more about the details. It's not just about the external environment, this business result, but definitely also about our internal performance, and the results of the new downstream program show up in the bottom line. As for the upstream, good news. So our production in the last quarter was 103,000 barrels per day, increase compared to the previous quarter, and also on a yearly basis we could reach our target with a 98,000 barrels per day. Also, in addition to this, we reached over 100% organic reserve replacement ratio. So all in all, I think good internal performance. Of course, if the crude price is below 50, that we will see in the bottom line.
But as you say, the world has turned somewhat for oil companies with the falling oil price. So how is MOL positioned to the lower oil price?
I think the falling oil price definitely means and brings new challenges in the upstream business. And actually, a lower crude price means good news for the downstream business. And in the upstream business, we have a mix of oil, gas, and regulated gas pricing, which also allows diversification of the risks. Also, as I mentioned, we have a strong balance sheet, long maturity, high short-term liquidity, and most importantly, we have a strong team in place.
And in the light of this, what impact will there be on your Capex program for 2015?
In terms of organic Capex, we want to continue and we can continue the practice of the last years, that we should be able to cover organic Capex from our operating cash flow. Our Capex plans are in the range of $1.8 billion, which means comparing to the 2014 $1.7 billion, this is very much business as usual. And we have the balance sheet to remain counter-cyclical and continue with our projects.
And on top of organic Capex, how do you view the prospects for mergers and acquisitions given this environment?
Well, our strategy essentially remained unchanged, that we are looking for growth upstream acquisitions, and we are looking for potential asset extension in downstream in the region. All in all, I think given our strong balance sheet, that this environment should create us better opportunities. And as we said before, we are not in a rush, so we have time to look for the appropriate opportunity.
Ferenc, you head up the downstream business, and we see that the macroeconomic environment is improving. What's your take on it?
Yes, indeed, after the last 5 years very depressed downstream environment, it's true that especially in the second part of 2014, we have seen a lot of good signs and trends. For example, the low crude prices and the low energy prices definitely support our refining and petrochemical business. We also have seen, especially in the last quarters, that the refinery margin, the cracks, started to increase. And currently we see a very attractive and favorable petrochemical margin. And on top of that, I think what is very important, that in 2014, year on year, the local fuel demand has been increased in our 3 major domestic countries, Hungary, Slovakia and Croatia, by 4%.
Can you run through the performance then, the downstream performance in 2014?
Yes, I can say that 2014, and again especially the second part of the year, was quite a robust year for MOL Group Downstream. If I compare it with 2011, what we use as a base year in our performance, in 2011 our clean current cost of supply EBITDA was $350 million US. In 2014 we could increase the current cost of supply EBITDA by more than $500 million US, and we reached the $870 million US clean EBITDA last year, which was a very great result. And I also very happy to state that it's not only the group level downstream performance has been increased, but all the major businesses within downstream, refining and marketing, retail and petrochemicals, could increase their performance.
And what was behind the improved performance, and do you see those trends continuing?
We put together a major efficiency improvement program by the end of 2011, which was tackling the whole value chain of our activity, starting from the production till the end of the retail sales. We had main areas like energy management, energy efficiency, maintenance efficiency, yield efficiency in the refining, and also country concept in the different commercial areas. And within that so-called new downstream program, because the program was dedicated to this new depressed environment in downstream, we were targeting very crucial organizational changes and unfortunately very painful headcount reduction as well. The final result of the program was that we have announced by 2012 to ourselves and also to our shareholders that we will increase our EBITDA performance within 3 years by more than $500 million US. And I'm very glad to report today that based on our last year's numbers, we have reached that. And I'm very thankful to our colleagues who were participating in the evaluation and then also on the implementation of the execution of all the actions in the program.
So what's the strategy for 2015 and beyond?
We will continue to maintain and to build our regional stronghold model. The model has got three main pillars. One is how we are handling and what we are doing with our assets. The second is our markets, and third one is our colleagues. From the production point of view, our very clear target is to operate highly efficient and top quality refinery and petrochemical assets. In the wholesale, we are going to increase our captive market share. In the petrochemicals, we are going to increase and develop further the whole elements of our value chain. And in retail, we will have a step change, mainly in the non-fuel area. And also, we will further grow our market share in the region. We have created financial targets. And I can say, and what we can announce, that within that 3 years, with the support of that program, we will achieve $1.3–1.4 billion US EBITDA by end of 2017 from downstream. And also, by the time our normalized cash flow should be around $900 million US.
How are you going to get there, and what are going to be the key elements of that program?
We took the 2014 performance as a baseline, and we said, and we have seen already even in 2014, when we had quite a good performance, that we have missed some opportunities and we have even further rooms for improvement. So based on that, we worked out a program. We have again more than 150 individual actions in the program, tackling efficiency improvement in the same production, commercial and retail area. And on top of that, we also count on the financial return of the last 2 or 3 years strategical investment, like the new butadiene plant in our TVK petrochemical plant, like the new low-density polyethylene plant in Bratislava, and also our investment into turning our Italian operation from refining to a wholesale, additional financial benefits for the next 3 years. So now we will run a so-called next downstream program when the target is within 3 years to increase our EBITDA generation capability by further $500 million.
In retail, you announced some significant acquisitions in the year. Can you give me some details around that and give me some more details about your acquisition strategy for retail?
Yes, in 2014 we have announced an acquisition of more than 240 retail stations, mainly from Eni and from Lukoil in 3 key countries like Romania, Czech Republic and Slovakia. Actually, those acquisitions were very much in line with our strategy, which also takes into consideration that retail's sales is much higher security to our general product sales in the region. And regarding the future, I can say that we have not changed our strategy in retail. We still believe that the retail growth is very important for our business, and we are very proactively looking for new inorganic growth opportunities in the region. I can say almost in each countries where we are operating now. And I also would like to add that for me retail is just not about the acquisition. Beside the acquisition, we also have put together a new conceptual change, changing the so-called old filling station into a new sales point network, which means that besides selling fuel oil, we will concentrate very much on selling customer goods and attracting more and more satisfied customers to our sales points.
So all in all, you're confident about the downstream business going forward?
I'm confident today because I know that we are in a good track, and I see that our people are able and capable to do the next step and to reach all the targets, what I said earlier, by 2017.
So a good 2014. So what's the outlook for 2015?
I think just as challenging 2015 or even more challenging than 2014, but we are ready for this. All in all, there may be different scenarios, but because of the balancing effect of upstream downstream, we should be able to generate more than $2 billion CCS EBITDA, even in an environment with, let's say, $60 crude price. We have a very strong balance sheet. We will be able to continue with the free cash generation after Capex, and most importantly, we have a team in place to face those challenges.